Assalamualaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Tria AINI, Management Class 22A, with NPM 22,411,037. In this video I will explain about tax audits. First slide about definition of tax audit. Tax audit is an activity carried out by the Directorate General of Taxes, DGT, to test taxpayer compliance in fulfilling their tax obligations. This audit aims to ensure that taxpayers have calculated, paid, and reported their taxes in accordance with applicable regulations. Slide 2 about purpose of tax audit. Testing taxpayer compliance. Ensure that the tax reported by the taxpayer is in line with reality. Collecting evidence. Collecting data and evidence to determine the accuracy of tax reports. Prevent and reduce violations. Early detection of potential violations and tax manipulation. The next slide about types of tax audit. 1. Routine audit, regular, conducted periodically to certain taxpayers based on the criteria set by the DGT. Usually conducted to test the compliance of taxpayers who are considered risky or potentially deviant in tax reporting. 2. Special audit. Conducted upon an indication of significant non-compliance or violation. Can occur due to reports from other parties or the results of DGT's risk analysis that indicate irregularities in tax reporting. 3. Field audit. This audit is conducted at the taxpayer's business location or place of business activity to verify documents and activities directly. 4. Office audit. This examination is conducted at the DGT office, where the taxpayer is asked to come to the tax office with the documents requested for examination. Conclusion of tax audit. A tax audit is an examination process carried out by the tax authority to ensure that taxpayers have complied with applicable tax provisions, both in terms of reporting and paying taxes. This audit aims to detect potential non-compliance, including tax avoidance or reporting errors, so that state revenues can be maintained. In its implementation, there are several types of audits such as field audits and office audits, which are selected based on the complexity and needs of the audit. The audit process begins with an official notification to the taxpayer, followed by the collection of financial documents, transactions, and other supporting evidence. Taxpayers have the right to file clarifications or objections to the audit results, but they are also obliged to provide the requested documents completely and on time. The results of this audit are often findings that can lead to adjustments to tax obligations, fines, or other sanctions if discrepancies are found. Tax audits are also an important tool to encourage taxpayer compliance, and for those who comply, audits can be a control mechanism that ensures that their tax obligations have been met properly. Conversely, non-compliance can pose a risk of large fines and even legal problems. In the modern era, tax authorities increasingly rely on technology and data analytics to conduct audits efficiently and precisely, especially to identify patterns of violations that may be difficult to detect manually. This shows that taxpayers must be more proactive in maintaining neat financial records, using tax consultant services when necessary, and following developments in tax regulations to avoid the risk of detrimental audits. Thus, tax audits are not only a control over tax reporting, but also an important element in maintaining the credibility of a fair and transparent tax system and supporting the stability of state finances.